From Morningstar.com. Equity mutual funds enjoyed very strong returns in 2013. Joining me to provide a recap of the year is Shannon Zimmerman. He's Associate Director of Fund Analysis with Morningstar. Shannon, thank you so much for being here.
Good to be with you, Christine. Shannon,
this is the time of year where investors do that review of their portfolios holdings. Let's start with the style box lens. When you look at the Morningstar style box in which categories have outperformed and underperformed, what do you see? Am I better off in small versus large, value versus growth, and so forth?
Yeah, certainly this year, smaller has been better. Everybody's a winner in absolute terms. The market is up substantially year to date, but small cap on a relative basis has certainly outperformed larger cap fare. Mid cap funds have done better than large cap funds as well. The valuation spectrum has been less of a factor, but still growth funds, at least at the extreme, so in the small cap arena, growth funds have outperformed value, and that's also true among large cap funds. Large cap growth funds have fared better than large cap value funds. Among mid cap funds, the reverse is true. Value has actually beaten growth, but the valuation spectrum really has been a small factor compared with the market cap factor, which has been quite large.
Okay, so I should keep this in mind as I review my holdings. So even if I have, say, a large blend fund that I know tends to lean a little bit toward growth stocks, sure, that might explain why it has beaten its peers so far this year.
Exactly right. You might have a manager who got lucky and was standing in the right place at the right time.
Okay. When you look at the sector view, are there any sectors that have performed especially well, and which sectors would investors look to as being sort of depressive when they look at their portfolio holdings?
Well, so utilities have fared the worst among the sectors, but the two sectors that we've kind of been talking about off and on throughout the year, consumer discretionary and healthcare, are the ones that are kind of going to go down to the wire. I looked just before I came down to film this segment with you, and consumer discretionary, as of last night, is up on healthcare by just a percentage point, less than a percentage point actually. So they've been neck and neck all year, and it's going to go down to the wire. Healthcare is particularly interesting because you might think that the companies that are doing best in the healthcare sector are those that would benefit from the dust finally settling, or mostly settling, on Obamacare, but that's not the case. It's really the biotech. So Gilead Sciences is among the top performers in the healthcare sector, and so is Biogen IDIC, which is up over 110% so far in the year.
So even if I don't own a sector fund, I may still have a fund. I probably still have a fund or two that have benefited from these types of exposures.
Absolutely, and such an important point too. A lot of times we'll field queries from reporters, and they'll want to know about the hot tech fund, for instance, and we'll say, well, it could be the S&P 500 because there's already 20%. If you're invested in the S&P 500 index tracker, 20% of your assets are already, more actually, in tech. How much more do you need? So that's true of healthcare as well this year. One of the funds that I cover is ClearBridge Aggressive Growth, which is run by one of the longest tenured managers in the industry, Richie Freeman, and his co-manager, Evan Bauman, who we had a chance to speak with about a month ago. They have about a third, a little over a third actually, of that fund's assets in healthcare right now, and Biogen IDIC is their top holding, and it's a huge position size too. It's about 11%. Lo and behold, the fund's doing quite well. It's a very volatile fund, very concentrated in terms of overall names, but then concentrated at the very top of the portfolio as well. But yes, it is having a terrific year, in large part. Good stock picking, of course. Richard Freeman is a good stock picker, but the having a third of your assets in healthcare has certainly been a benefit.
When you look at active versus passive, this is a topic that investors are keenly attuned to. We've seen a lot of the flows going to the passively managed products. How have active funds done versus passive year to date?
Well, this is a good year by and large for active managers, not in the large cap arena, which in some ways stands to reason. So the typical large blend fund has lost to the S&P 500 trackers or a total stock market tracker this year, which kind of makes sense. I'm always surprised when you have these sort of middle of the road large blend funds that do have a year of outperformance, because obviously the large cap arena is the most efficient part of the market. It's hard to buy household names like Johnson & Johnson well. So this year, at least relative to the S&P 500, the typical large blend fund has lagged by a little less than a percentage point, and then versus a total stock market tracker, a little more, I think, than a percentage point. The story is a little bit different among mid-cap and small-cap funds. So historically, the S&P mid-cap 400 index has been a very difficult bogey for active managers to beat. But this year, they've beaten it by almost 3 percentage points. And then, historically, the Russell 2000 has not been a very difficult benchmark to beat. And lo and behold, the typical small blend fund has outperformed the Russell 2000 yet again in 2013.
Okay. Shannon, I'd like to home in on a few actively managed funds that are big constituents when you look at 401k plans. Let's talk about how, say, starting with Fidelity Contra Fund, how it has done. Can you just give us a quick snapshot?
Well, interestingly, Fidelity Contra Fund does not have an outsized stake in healthcare, but it is one of the biggest fund owners of Biogen IDIC, even though because Contra Fund is so huge now, it's over, what, $108 billion, I think, right now. It's a relatively small position, but in terms of the shares outstanding for the company, it's quite big. So Contra Fund isn't having a shoot out the lights year, but it's having a strong year, above average year. Interestingly, given that fund's track record, and the manager, obviously, Will Danoff, quite a talented manager and has a fantastic long-term track record, and given that this year flows have been coming back in to domestic equity funds, that fund has actually seen outflows every month this year except for January, which I find somewhat surprising. People tuning in to how much it has in assets, and it's still open to new investors. They've not closed it. He thinks that he's not capacity constrained even at $108 billion. So having an above average year, but not a stellar one.
Shannon, let's take a look at American Funds Washington Mutual. How has that one performed year to date?
So like Fidelity Contra Fund is having an above average year, but not a terrific year. It's in the 44th percentile through the end of last month. It's an interesting fund because in the past, we've talked about whether or not there's a dividend bubble or a bubble for dividend-paying stocks. This fund has a yield of about 2%. It also has a quality bias, and quality companies often command higher premiums. And this is a large value fund, but on every value measure, the fund is more expensive than its typical peer. Price to earnings, price to book, price to cash flow. It's a pricey value fund, at least on a relative basis. But it's still doing quite well, just not a shoot out the lights kind of year.
Okay, how about Vanguard Wellington?
Vanguard Wellington is actually having not a shoot out the lights kind of year, but a better one. It's just outside the top quintile of its category. And that's an interesting fund as well because there's a bond sleeve, and they have historically been quite strong bond managers, but it's going to be interesting to see what the strongest bond managers in the industry are able to do if and when, and presumably it's when, interest rates do finally spike and inflation finally does rear its ugly head. Historically those are horrible for bond investors. It's going to be interesting to see if the talented folks in the industry are able to dodge that bullet.
As people look upon their portfolios at year-end 2013, what kinds of changes should they think about making? What changes should they avoid making right now?
Well, sure. The first thing to say, I think, is stick with your game plan. It's something that most investors have thought long and hard about, and if the thesis that informed that game plan when you first put it together still holds water, there's no reason to lurch towards something that you didn't already have in your portfolio or lurch out of anything.
And if you didn't have a game plan, get a game plan.
Exactly right. However, that said, given what we were talking about at the top of the segment, it may be the case that you have more allocated to small caps than you thought just because of market appreciation. The same might be true, if only slightly less dramatically, for the growth side of your portfolio as well, because growth has outperformed this year and kind of incrementally last year as well. Then your fixed income exposure is a important consideration right now. We were just talking about Wellington and the talented bond managers that they are. It's going to be tough when inflation and interest rates do rise for anybody who's invested in fixed income to dodge that bullet. You might think about, and I know this is advice for retirees, but you might think about allocating new investment dollars that might otherwise go to a fixed income fund to cash and be opportunistic once the fixed income market finally rights itself. The last thing I would say is that particularly, it's always a good idea to buy the unloved as you rebalance. Great funds that have been out of favor just because of their style. It's a smart strategy for long-term investors. But particularly right now, when the market is fairly valued, according to some, even overvalued, it's an excellent opportunity to sort of, if you're going to send your new investment dollars into the equity markets, to find the funds that have been out of favor, because it's a better way to find at least a relative value.
Okay, so your advice is have that strategic asset allocation plan, stick to it, and then rebalance back to it if you're out of whack.
Exactly.
Okay, Shannon, thank you so much for being here.
Good to be with you, Christine.
Thanks for watching. I'm Christine Benz from Morningstar.com.